Hello to everyone. Today I am here with a new topic that is financial need assessment by the banks. Or in another way, we can say how banks should assess the financial need of their customers in order to build their quality assets. As loans are considered to be the assets for the bank, if the assets for the banks are not quality assets, it will give a straightaway damage to the banks in the shape of higher level of the NPL. Financial need. First of all, introduction to financing. Financing is the process of providing funds to meet the need of a person. Here we mean by the person is any type of a individual or any type of business or non-business entity. Banking financing are categorized. First of all, secured loans and the unsecured loan. Asset-backed security, asset-backed security-based lending. Most of the banks are offer secured loans to their customers. Other type is unsecured loans, asset not backed by any type of security. We have an example of the credit card. Credit card is considered to be the unsecured loan, and it is also called as clean placement. Other banking financing include the funded finance facilities backed by bank funds, non-funding finance facilities not backed by bank funds. In case of trade financing, like a customer is going to open an LC and he committed that the payment will make by the customer. But in that case, the bank take the responsibility on behalf of the customer. If the customer fails to meet its financial obligation, bank become responsible for the payment. In this way, bank generate that commitment as a part of their contingent liability that is recorded off balance sheet because this liability is not backed by any type of the cash. Similarly, guarantees are also considered as non-funded commitments because guarantees is also not backed by any type of cash, but it's a commitment. If the customer will fail to meet its commitment with the bank will have to make the payment. Trade finance involves the variety of the financial instruments that can be used to meet the need against an import or exports. Long-term financing need. Long-term financing need is to meet the funding against the capital expenditure. Capital expenditures are the expenditure against the tangible assets like machinery, equipment, furniture, vehicles, buildings, land, etc. That is assessed by evaluating the production capacity is to consumption. If a customer is short of consumption as compared to its production capacity, it means the fund may not be required against the capital expenditure. There can be other reasons, that is, because of the change in the technology. New technology may be considered as the cost-effective technology. So in this way, there are chances that its competitor starts selling its product at the cost of that customer. So the customer will have to bring new technology to compete the market. Other thing is the import of the asset for the new business setups. Normally, long-term financing are required for these purposes. Short-term financing need, short-term financing need is to meet the funding, to meet the working capital that is against the production. Running finance to meet the day-to-day expenditure. Seasonal financing are normally against the crops. Short-term financial need is assessed based on the minimum cash requirement to meet the day-to-day expenditure, and cash inflow is to outflow from the operation than non-operation. So after developing these types of the cash flow, you are able to assess the short-term financing need. The cash flow statement is one of the most effective tools to measure the short-term financial need that is categorized in four parts. Cash flow from the operation that include the revenue of the sales, net of tax or commission, sale of scrap, revenue from other services. So that part is considered to be the cash inflow from operation. Cash inflow from non-operations that include the borrowings, sales of assets. Borrowing includes all types of the borrowing, borrowing from financial institutions, borrowing from family and friends, borrowing from your subsidiaries, borrowing from public in the shape of debt instruments. Thereafter, cash outflow from operation that include the all type of the purchases against the raw material and other type of the purchases, general and admin expenses, other operational expenses, interest payments, tax payments. So these are the part of cash outflow from operations. Cash outflow from non-operations that include capital expenditure, that is against the sale of all type of tangible and intangible assets. Debt payments, whatever you have received in the shape of the borrowing, and its repayment is considered to be a part of cash outflow from non-operations. Dividend payments. Thank you very much. See you soon with the upcoming video of the same topic very soon. If you are interested to have update videos on banking and finance related topics, please do subscribe my channel.